Okay, good morning, everyone, and welcome to what is the 59th edition of the Coffee Microcaps Morning Meeting. You're all very welcome. Just a couple of quick intro slides, and then we're going to get straight into it. My name is Mark Tobin. I'm the founder of Coffee Microcaps. For anybody who's joining us for the first time, and for all our regular listeners, you're very welcome back. I'd like to mention our sponsor, DMX Asset Management. If anybody is looking for a microcap or small cap fund, I encourage you to jump on their website and have a look at the relevant PDSs available there, or indeed reach out to Stephen or Michael. Their details are there. A quick compliance and disclaimer notice. For anybody who's joining us for the first time, the companies we generally have on here are capped under 300 million Australian, are in revenue and approaching cash flow break even, or indeed are already profitable. We generally don't have companies here from the resources in the biotech sector, what I call then industrial microcaps, which is a catch-all term for microcap technology, microcap financial services, microcap healthcare. And we are going to have 4 very unique companies on this morning. Each company is going to have 30 minutes broken down to a 20-minute preso, 10 minutes of Q&A. If you have questions for our presenters, please type them in the Q&A box rather than the chat function. It just makes it easier to moderate the Q&A session when we get to it from my side. Please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow morning. You can follow us on Twitter, LinkedIn, YouTube. I also write a weekly paid subscription newsletter that you can grab on the Substack platform. We're going to quickly jump to Mobilicom. I'm delighted to be joined by the CEO and founder, Oren Elkayam. And just to run through all our presenters, then we're going to switch across the Tasman to Gary Rohloff from Laybuy's group. Then we're going to head up to Southeast Asia. We've got Mark Samlal from PayGroup joining us from Singapore. And then we're going to bring it back home to Sydney for Plenti Group, and we've got Daniel Foggo joining us. So without further ado, I'm going to stop sharing my screen and I'm going to hand over to Oren. Oren, if you want to start sharing your screen, I'll let you know when and if you can just go to full, there we go, perfect, you're ready to go.
Good morning, everybody. I'm glad to be with you. I'm talking to you from Europe right now, so it's great that you're on your morning. I'm at my after midnight. I would like to present Mobilicom. I'm the CEO and co-founder of the company. A few words about the company's introduction. So Mobilicom is an end-to-end provider of cybersecurity and smart solutions for commercial drones, robotics, and autonomous platform. We develop over the years a portfolio of patents and technology which are unique to expertise, and those are granted. And based on those, we brought to the market a wide range of hardware, software, and cyber solutions that are all embedded and already in use and field proven by numerous customers, over 70 across 15 countries. And you can see on the map that our focus area is mainly Israel, United States, and Europe, which are the hubs of operations of drone technology and drone platforms. Among them, we have 7 top-tier players that chose one of Mobilicom's solution as their key components for their drones and robotics. The company is focusing on a large market of the drones robotic, which is growing and expected to be over $50 billion in the next 5 years. And our specific segment of small drones and robotics, our specific segment that we are targeting is over $18 billion of opportunity for the company in those years. Just a few words about the market itself. Although the drone and robotics markets is divided to different segments, we are only working on the government and the commercial segments. The consumer segment on the top is something that we don't target. Obviously, like many other technologies that start and are seeded first in the government defense side, the same happens with drones and robotics. And this is the majority of the market today, but over time, towards 2024, you will see that most of the market will come to commercial, and commercial will be growing rapidly and strongly and will be the significant portion of the market going forward. Mobilicom's offering, if you take all the smart solutions that we propose to the manufacturers of drones or robotics, we can cater up to 40% of the system value, which means that we are providing key components. When we are discussing drones and robotics, they are built from hundreds of pieces, much like if you look on your car, there are thousands of pieces in your vehicle. So drone manufacturers, like car manufacturers, are buying the key components of technology from other vendors, for example, Mobilicom. In the car industry, the equivalent is that the brand names Volvo, Audi, Mercedes are buying from top tier vendors of technologies like Bosch, Delphi, Continental. And we, as Mobilicom, are providing the key components. You can see that the key elements in drones or robotics are the ones that are shown on the screen. There are 9 key elements or key systems within such drone or robot. Those are the elements that sets the performance, the capability, and the valuable assets within the drone from hundreds of pieces. Mobilicom portion today is already covering 4 segments of the drones or robotics needs. And over time, we intend to increase our footprint and bring more and more of the end-to-end offering by partnership or other means, and be a one-stop shop for all. If we look on the offering of Mobilicom, so when we are saying smart solution, there are several segments. For example, we provide data link terminals. In this family, we have already more than 6 products in the market that are targeted, that are used to control, to operate, to receive the videos and sensors, and to share the telemetry of the operation of the drones or robot by those that operate it. We also provide a family of mesh networking that can share and expand and operate fleets and swarms and larger quantities. Those are more sophisticated solutions of communication, obviously, and we have over 8 products already in the market. Recent solution that we entered to, those are the control terminals. Those are the elements that help you to operate the systems or the mission of the drones or robots. We have 8 products in this segment, and which, although it's new from the recent 3 years, and those are the hardware pieces that we are selling. Recently, we introduced to the world the cloud software solution and the cybersecurity. Both of them are SaaS models, recurring revenue that will come to the market. And those are important because that transit the company from just hardware to company that have hardware, software, and cyber solution. Those key building blocks for the drones or robotics are sold to global customers, like the logos that we see over here, which are some of Mobilicom customers. Among them, you can see top tier ones, and they are embedding our elements into the creation of their platform, like the solutions you see at the bottom. It could be an vehicle, autonomous vehicle that doing patrol on borders or fences and things like that. And we are talking about fixed wing drones or robotics for industry or other means. So we are providing the key building blocks to the manufacturers of those platforms that use them in order to create their overall solution. Mobilicom is known for its outstanding security and capability to perform in harsh environments that set us apart from others, and the fact that we are providing an end-to-end offering, not like some of the competitors we have in each one of the fields. We can complement a full holistic solution for our customers. The fact that we took a unique approach of an end-to-end provider gave us the ability to bring and guarantee to our customer one-stop shop that can bundle package of solutions together at lower cost to our customers, the drone manufacturers, and guarantee to them performance, security, and higher quality of integrated and well-proven elements that work together perfectly. And that's advantage our competitors cannot achieve and bring. More than that, and key essential part of our growth is that a cross-sell. Once we enter with one of the pieces, we can then leverage our position within the partner or within the customer to cross-sell other pieces as well as the software and cyber on top of that. And that gives us unique position in the marketplace today that none of the competitors have. Financials, for those that don't follow Mobilicom, the business is built from 3 pillars of revenue. One is repeat hardware sales to the manufacturers of the drones robotics. Since we are dealing with high-end technology and patented technology, the gross margin of our sales is very steep and high, which is over 65%, which is very, very high. On top of that, with the new solutions of cyber and software, we'll be able to provide SaaS model recurrent revenue on a yearly base. And the third element is support and post-sale packages that enable the customers to integrate as well as operate and maintain those systems. And that's again a recurring yearly process. As we have more and more customers in the field coming to more deployments as the market is evolving, we'll be able to kick in more of the cyber and the annual recurring revenue elements. If you look on the strategy that we've built, Mobilicom shown in the last quarter, we published the 4C figures for the Q4 of 2021, which is our end of year financials. You can see that the company strategy is working well. We managed to grow and our customer receipt by over 200%. Our cash flow, net cash flow is decreasing and is very low. We have enough cash in the bank to fulfill our strategy, and the gross margin is high. We managed to lock deals for the coming quarter as well as R&D programs going forward, and the momentum is seen and very, very positive and high growth as we see from comparison to previous quarters. Strategy-wise, I think this is one of the most critical pieces to understand in the story of Mobilicom. When we are going to the market, there are 5 stages to lock, work, and create the revenue and then be profitable for the company. Phase 1 is the interaction stage, when you are approaching a new customer, doing the business development and marketing activity in order to create the initial cooperation. This is 0 revenue from the company on that stage, but important research and interaction stage. Phase 2 is the most important phase in a design win business model like Mobilicom is offering. Since over here in the first phase of phase 2, we are either chosen by beauty contents like Fleer Teledyne, and NASDAQ 100 giant company with over $10 billion of sales, chose Mobilicom because we outperform all the 6 other competitors in a beauty contest they provided needed for their deployments of their drone. And this is one way, or by a formal bid. We have another example of Israel Aerospace Industries, which is a giant on the world in this space, and they had a formal bid that we won. In one of those elements, once you winning that, the customers is starting to take 1 or 2 of your pieces as building block and build a drone or robot around that, then inspect it, certify it, and demo that. If they need to change one of the key elements of the smart solution, that means going back significantly in time, a lot of effort, and very expensive process. So they don't tend to change things if it's not really, really mandatory. So it's a sticky business. Once phase 2 is completed, you can guarantee that over time, doesn't matter if you take 9, 12, 18 months, you will get to a substantial revenue eventually of steps 4 and 5. And that's why it's a very important phase, like any design win of other customers. Much like if you are chosen as the engine of the next Ford car, you know that over time, you're definitely going to lock and win those revenues. And that's the equivalent for Mobilicom. In step 2, we are usually doing tens of thousands of dollars. It's not much because it's just the process of integration. Step 3 is where the customer is already using what they initially manufacturers in order to see the market and engage with their customers and deploy initial systems. These small quantities is already bringing to Mobilicom with one product, not all of them, just if you seed one of our product inside, hundreds of thousands of dollars. Step 4 is even when the customers are deploying larger quantities and moving to scalability. With them, it's already 7 figures and millions of dollars from such a customer. And step 5 is utilizing our cross-sell and other products and the complete end-to-end offering. And then you can exceed in $10 million on a yearly base. So obviously, as you shift more customers, the big ones, the mid-size one, from the phases, you guarantee the volume. We've seen Aya and Rafael already shifting to phase 3 and creating hundreds of thousands of dollars. The Israeli MOD already getting to step 4, over $1 million. Elbit, which is past step 4, that created over the last 2 years over $3 million. And that shows that the mechanism, the business model is working, and the end-to-end offering and cross-sell is working as well. Over time, we can see that we are gaining more and more new design wins with new platforms of different customers around the world. We are adding new ones from quarter to quarter, and that takes them time to materialize their system and product of drone or robot and bring it to the market, certify it before they can start seeding their market. And as the market is evolving going forward, over those steps that I showed before, Mobilicom will get and shift for higher revenue stages that will enable the company to turn to cash flow positive and be very profitable with tens of millions of dollars in sales that will automatically translate into the market cap of the company and the profit of the investors. Obviously, the understanding of this slide is critical to the success of the company and those that follow our releases, our products, and the fact that this is the strategy and it's working, and seeing one step after the other going and happening. Understand that the revenue of the future is already guaranteed right now. And that's something that interaction with the investors is important key fact to understand the company's success, that it's already materializing right now. In a nutshell, and to summarize, Mobilicom is an end-to-end provider, having in hand over 20 products in hardware, software, and cyber, which are the core technology elements within a drone system or a robot system or autonomous system. Those patents, those products are protected by proven technology and patents, and are under use and field proven by numerous customers. We're pursuing a large market that is growing, especially the small drone and robotic market that we are focusing on is the essence of the growth in the coming year. And that's something that we will enjoy. And we already proven that we are locking giant customers like Airbus, FLIR Teledyne, Israel Aerospace, and many others, as well as second tier and third tier, and showing that the business model and the strategy is working and creating the revenue and the ramp up in success with those customers. This is the summary. I welcome any question you might have.
Thanks, Oren, for the presentation. Maybe if you could just leave up that contact us slide while we're on the Q&A, just in case anybody wants to reach out for a one-on-one or might want to get on a distribution list for IR. A couple of questions, if I could, I might get the ball rolling here. The cybersecurity and the cloud offering, will that work with other hardware, or is it specifically linked to your hardware? So if the drone manufacturers don't take your hardware components, can you still sell them the cloud product or the cybersecurity product?
We can enable other customers to utilize our software and cloud solution. Obviously, if you are choosing our components where they are designed to match and work perfectly, you can guarantee the best performances. Much like if you are buying the complete set of solutions from Apple, the computer, the phone, the earbuds, and the watch, you can guarantee the best performance. So much like it's over here, and you enjoy the fruits of the short time to market integration and the guarantee of the security. More important is that Mobilicom Cyber is by itself an enormous jump and promise to the market. We are leaders in this area. We are first to market with a comprehensive 360-degree AI-based solution that can protect your platform against more than 10 different attacks. And the fact that we are locking that and controlling the other pieces guarantee that you protected from different angles of your system, from the cyber side, from the cloud side, from the communication, from the control elements. And that's why it's very powerful, the protection grade and capability when you are choosing the other products. It's feasible, but the most recommended in the utmost performance is gained by using our components across the entire chain, but it's not mandatory.
Okay, and I guess to follow on from the Apple example, they're using their own chips now, or chips specifically designed for their products. We can draw an analogy there. On the cybersecurity, I just want to talk about the Ministry of Defense contract that you did last quarter with the Israeli Ministry of Defense. Can you give us a bit more detail on that, how long it was for, and you know, is this a kind of proof of concept, or is this something that you feel is going to you know, expand within the, say, different divisions of defense, from the Army to the Air Force to the Navy?
So I think that for those that are not familiar, we are busy and working and developing the cyber solution for the last 3 years. Cyber is a critical factor for different segments of the market, and definitely one of the important pieces of technology in our world for the last decade. But the drones or robotics cannot use the cyber that you see for your bank system or for your hospital, for other means, only because they are different in the nature of operation. Those are autonomous elements that are working in large number. Each one of them is very independent, doing different missions scattered around the world, controlled directly or indirectly through other systems, very vulnerable by the fact that they're operated by wireless means. So it's easier to tap, easier to block, easier to jam. And therefore, it's a critical piece that the solution for cyber for drones and robotics has to come from a different angle and idea. We understood that from the fact that we work with challenging environments of different army and agencies of government, and they brought us the challenges, and we developed over the years solutions. The fact that we've done it with very close partnership with those cutting edge customers and first early adopters gave us an edge over the market. The solution that we are offering is very comprehensive, dealing with many attacks, and that gave us a leading position. Eventually, they made a decision to choose us over giants that are trying to bring solutions. The leadership that we've shown and the quality that we've shown caused them to choose us for the small drones and small robots where we excel and we can bring our efficiency to the market. And that deal was not planned, by the way, for this year. And we are lucky that they decided to work with us. And that's showing a very big confidence that they have in our solution over anything else that exists there. And we believe that these reference customers, while they will deploy it and start to use it and validate their operation with it in the market, will continue with the buys, and that will set a very important reference for other customers. The fact that the very advanced defense forces of the Israeli government chose the cyber of Mobilicom for their fleets of drones and robotics is a big message to the market. And we're going to utilize that with the Americans, Europeans, and other key customers we are serving.
And on the hardware sales side, you when you were going through that diagram of the different phases, do you get a, I guess, a production a production plan from the guys who are taking your hardware components to say, you know, we're looking out the next 6-12 months and we can say, okay, this is what our production is going to be. And then they feed that back to you and say, okay, we need XYZ number of components to, you know, fulfill our production requirements. Or how much visibility do you have on forward production for, you know, your end clients?
So it's important to say that we are in the small drones and small robotics market, both for the government and commercial aspect. It's in early stage, so they have less visibility of the volumes and the deployments that they are having. Some cases we do have that, for example, Elbit, which are more mature with their products and already seeded initial volume deals across Asia Pacific. So we've given quarterly elements that we have to provide in order to fill their production of the entire solution. So over there we have it. We anticipate that over time we will have it with all the customers, because once you are kicking in with the production and they're starting to see the market and create the demand, so they will have visibility on their end, and they have to translate it to visibility to the key providers, especially since some of them are using several blocks from Mobilicom already. And we have to be prepared in advance. So that will give us more visibility. It's starting to happen. It's still in early stage market, so it's not always clear to them. But once it's clear, we have visibility, and the ramp up is done jointly between the two of us. And more important is that once they are doing production in the next 5-10 years as a sticky business, the post-market maintenance, repairs, and parts is also coming back to Mobilicom and guarantee additional sales. It's like the car. You have the initial sale of the car that they have different elements, but the repairs of the cars are generating even bigger revenue to the car manufacturers from the components.
And in terms of that, I guess, sales cycle, what are, you know, some of the things you're looking to kind of land, I guess, in the next, say 6 to 12 months? You know, what should people be really watching out for? Is it more deals on the cybersecurity side, or is it, you know, just a ramp up of the hardware business as you move more customers from, say, that phase 2 up into phase 3 and 4?
So I think that one of the things that we are concentrating on is take the big giants of the world that we believe that will be the leaders of the drones or robotics, small drones or robotics, and see them shift over time from stage to stage, and for us creating and jumping in the revenue and creating larger deals for us. So we expect that Rafael, IAI, and FLIR will all shift onto the right side, as well as the others, and that will build more momentum, more success, and more volume from of production to Mobilicom and revenue, of course. And then we expect that second designs of additional platforms that they're planning will also come to us and be going back to phase 2 with additional new designs of new platforms. We see that happening already with Elbit, that we started with one platform, with one solution, and we cross-sell additional solution and expand it to additional platform. So we expect that, because once you build a close partnership, they utilize your components in other new platform they're designing. So that's additional way to broaden our business. And then on top of that, anyone that we seeded our hardware inside, it's easy for us to use that as an add-on for our software, either the cyber or the cloud. And we expect that in 2022, we'll see initial deals on that will expand over time to larger volumes in 2023. So yes, shifting the customers will bring us more deals and more visibility and more growth, as well as new platform they're designing. On top of that, we will bring the software cyber that you will see more deals from that coming. But first, the foundations is seeding the key smart solutions inside.
Okay, Oren, we won't take up any more of your time. We're actually just up on time. I appreciate you coming on and giving us an overview of Mobilicom, given how late it is on your side over there in Europe. If you could please stop sharing your screen, because I know Gary, our next presenter, is patiently waiting for us in Auckland. Gary, if you want to start sharing
Thank you
your
very
screen.
much, and have a great day over there.
Thanks, Oren. Yeah, so Gary, if you want to start sharing your presentation.
Just 1 second, Mark. I'm just pulling up the shared screen now.
Okay, no problem.
Can you see that okay?
I can see the cover slide now, Gary. You're all good, mate.
Oh, great stuff. So look, thank you very much for having me on with you today, Mark. What I thought I'd do is quickly run through some of the highlights from our Q3 FY22 results presentation that we gave to the market recently. And I was thinking we'd leave plenty of time for questions that may or may not come from the audience. So I'll whiz through these slides pretty quickly. I want to highlight some key items, as you might expect, and we will leave plenty of time for questions at the end of this, all right? So I guess on a performance highlights perspective, we are incredibly proud of some of the milestones we have achieved come the end of Q3 FY22. We've recorded our annualized GMV of north of $1.1 billion. That's a 51% increase in year on year. And our UK business has grown its GMV by 70% year on year. So in a little further into this presentation, I'll talk to you about our strategy around the UK, but I think it's relevant when you look at that growth engine and see the progress we are making over there. That's not to say we are not making progress here in the Australasian market. New Zealand is our home market, of course, one we are very proud of in terms of our market position here. And we continue to grow that Australasian market 28% year on year in what could arguably be described as the most competitive buy now, pay later market in the world. The quarterly income growth at 42% is a number we are particularly proud of. It just demonstrates the fact that we continue to drive our revenue in this business. We're focusing on maintaining that growth, and we're seeing that more and more as we progress our business. Our active merchants in the UK up a staggering 166%, and active customers still up 50% year on year in the UK, and 35% year on year here in the Australasian market. So all those graphs going the right way for us, and you'll see a little further into the presentation just how that looks on a month-on-month basis by region. Just getting on to that, here's an overview of our targets and just re-representing those numbers in a pictorial fashion. And you can see the trajectory we have been on in GMV quarterly with that big spike as we went into the Christmas period. I'll talk a little bit more about how effective that was as we get onto the regional slides. So the UK is the one that we have classified and talked about for a long time now as being our growth engine. And you can see that quarterly GMV up 70% year on year in the UK. What was really interesting about that for us was that December, which is traditionally a lower GMV month because retail comes off somewhat after the massive November when you had Cyber Week, was actually 10% up this year. So our December we had anticipated, as we had last year, being probably flat to November. We were actually 10% up in December in the UK. So a really strong result for us. We added 40,000 customers, active customers over the quarter. I think it's important that people concentrate on the fact that these are active customer growth. We add a lot of customers that may default, they may choose not to pay us, so we suspend their account. We don't recognize them as active. If they are delayed in payment, we actually suspend their account. So our active number growth at 51% year on year is a very good result for us. And as you can see at the bottom right hand of that screen, or the bottom quadrant, our key merchants include some of the biggest names in retail in the world. And we are continuing to add merchants every day up in the UK market. From a Australasian perspective, we continue the growth trajectory we have been on. The ANZ market is a very mature market. It is highly competitive, as we are all very familiar. We have long held the view that Australia is a market where we look to support our New Zealand merchants who ship or have a presence there. But of more recent times, we've started to grow that business with new merchants, and you can see some of the very well-known names in here that are familiar to those of you who are in Australia. So still continuing to grow our active merchants, 41% year on year, which in a mature market is outstanding growth. I'll just briefly track on the financial. Our revenue momentum is continuing. We're up 42% year on year at 13.5 million for the quarter. So very happy with how that's progressing, and you can see the significant contribution coming from that UK and jurisdiction. Our annualized GMV, as I've spoken to, is up 51%, with the UK up 70%. And we have our net transaction margin for the quarter was adversely impacted by increased fraudulent activity. This was anticipated going into that peak period and felt by everyone in the e-commerce space. We have seen a marked improvement in the reduction of fraudulent activity in the December month and through into January. Our two funding facilities set us up very well for the future. We have a facility with Partners for Growth, which is a £30 million facility at an LVR of 75%. And we have a Kiwi Bank debt facility of 30 million Kiwi with an 80% loan to value ratio. There has been some speculation that I have seen and read about, the buy now, pay later are going to get knocked around by increased interest rates on their cost base. That's not the case with Laybuy. We have a fixed interest rate borrowing out of Partners for Growth, and that fixed rate actually falls as we scale. So we have no exposure to an increased interest rate regime over there. The Kiwi Bank facility is a floating interest rate, and we've done the maths on our portfolio. A 2% rise in interest rates across our portfolio adds 4 basis points cost to our NTM. So it is minimal at best. We are very unconcerned by a rise in interest rates and the impact on our cost base. From a strategy perspective, we've always been very clear that we had 3 pillars that we were working on. One was the obvious increase of market share in our established markets, and that is the New Zealand and Australian market. As I've said, Australia hasn't been a major focus for us as we looked at growth in the UK, but we're seeing increased interest out of merchants in Australia and are adding merchants on there all the time, as we are in New Zealand. Our growth in the UK is the one that we are most focused on, and I'll talk to that in a little minute as well. And we have looked to not only improve the operational efficiencies of our platform, but also improve the service we offer to our customers, both on the consumer side and the merchant side. So let's have a look at how we've been doing. In our established markets, we said that we were targeting verticals around health. It should be health, not health, and beauty, travel, and ticketing. We've achieved that with some very well-known names, as you can see there. We are the official sponsor of Super Rugby teams here in New Zealand, providing access for fans to buy merchandise and tickets via Laybuy. And in the new to Q3 column, you can see some very well-known brands in Australia, such as Quicksilver, Board Riders, Brand Culture, the PAS Group, etc. So we've got some very good brands coming into the business, and we are delivering on our strategic goals of growing the verticals of health and beauty, travel, and ticketing. Particularly relevant in the travel space now that the borders are reopening in New Zealand, and we're seeing an increase in traffic through our partners in that travel space. From the UK perspective, you can see there the monthly growth that I was speaking of earlier and the trajectory we've been on versus last year. Ignore the colour legend here. The dark blue is obviously FY22, dark purple, the light purple is FY21. But you can see what I was talking about last year. November to December was flat. this year, November to December, up 10%. So a really massive increase into that December month. That was driven a lot by our app exclusives product, which I'm talking to over here. And interestingly, with our app exclusives, the repeat customers are 73% compared to the 63% of our direct integrated merchants. To give those of you who are not familiar with our app exclusive product an overview or context for what that is, we have partnered with affiliate program providers like Rakuten, Awin, and others who give us access to the retailers like Amazon, River Island Sports Direct, Microsoft, Timberland, etc., via a integration with them as an affiliate partner, and customers who download our app can shop at all these merchants where we inject a virtual card into the checkout of these massive retailers. So you can see since we launched this in September, we've had over 600,000 purchases and an annualized purchase frequency of 14.7 times per year. So this app exclusives now gives our customers access to all of the major household brands, as well as the brands that we have a direct integration with, which include the likes of Boohoo, JD Sports, the Hut Group, etc. The platform enhancements that we have driven have centered on two card-based products: the Tap to Pay in-store solution, which is really continuing to drive GMV and has doubled volume from Q2 into Q3. The app exclusives, as I have just alluded, is a result of a partnership with MasterCard and EML, and that injects a virtual card via the app to the checkout of these massive merchants, allowing our customers to shop across these well-known brands. We've increased the efficiency of our customer support team by rolling out our virtual customer service assistant, Hugo, and that is an automated bot powered by Ambit and is now taking care of just on 10% of customer inquiries through our platform. A significant effort from our team around security and data protection means we're now PCI DSS level 1 compliant, which is a great validation for the efforts of the team. We've now got site reliability engineers across both New Zealand and the UK, providing us with 24/7 coverage, and the initiatives that we have put in place to combat fraud are resulting in strong downward trends. So we are seeing the benefits of the work we have been doing right across the board. I think what is really interesting from a market overview perspective is just how new Buy Now, Pay Later is in terms of global growth. We down here in Australasia have become very familiar with this product, and it is certainly part of day-to-day life here, but in relative terms, Buy Now, Pay Later is in its infancy elsewhere in the world. Global e-com payment methods have been predicted to increase by the following percentages over the course of the next for 4 years, from 2020 to 2022. Again, the colours have been transposed, so 2024 is the dark purple. But the two growth areas are digital wallet, that is predicted to grow 16% over that 4-year period. And down here, you can see Buy Now, Pay Later predicted to grow 100% over that period. Laybuy participates in both these growth areas, both the digital wallet and obviously the Buy Now, Pay Later. So we're very well positioned to take advantage of these global e-commerce payment methodology rises over the coming years. From a regulatory framework perspective, we have been fully involved in all discussions with Her Majesty's Treasury, the FCA, and we're participants in the Willard Review, and we have tabled our responses to the discussion paper issued by the FCA. Similarly, in New Zealand, we are full participants in what is happening in that regulatory environment here. From our perspective, what is being proposed around credit scoring, affordability checking, and continuous credit reporting is something that Laybuy does already, so there is no change to our operating model to align to any regulatory requirement that may come to pass. From an outlook perspective, I think it's always important when you're talking around an outlook to reflect on what you've achieved. We have achieved that GMV target of annualized target that we set ourselves of $1 billion, and we're on track to achieve our revised revenue target. We are accelerating our growth in the UK, and to drive that position that we have in the market, we've carved out a very credible one of the top 3 players in the UK market. Our business model regarding regulation, as I've alluded, we remain very confident that we will align to those changes. And some of the new opportunities that we have are around a new ad offering within our Laybuy app that will see us capable of adding additional revenue streams to the business. So I'll stop sharing there. I will open up for any questions that you might have. And for some reason, I can't open my video, Mark, so that may be something at your end. But
yeah, we can. Maybe if you, Gary, if you want to throw back up the slides there, just in case you might want to refer back to a particular slide in response to one of the questions. So yeah.
Yep. No problem at all.
You can leave the contact us one up there just for the time being. I think it was the
all right.
One.
I will. No problem at
just, I might just kick off the questions while we're waiting for one. In terms of the competitive landscape in ANZ, as you say, it's a much more mature market than globally. I mean, where is buy now, pay later, do you feel, in that market? Is it like fully mature now, and it's people doing various initiatives to kind of steal market share from anybody else, but the overall market isn't really growing because it's as penetrated as it's going to be? Or is there still scope for penetration from all buy now, pay later providers? Where are we in that context?
Yeah, look, I think we're still on the early stages of the maturity curve, Mark. Unquestionably, in Australasia, buy now, pay later is very prevalent, but the reality is we're still growing at 30% year on year in those markets. We are expanding our verticals, and this payment method is being adopted more and more by people who are seeing this as an alternative budgeting tool for them and assisting them with their money management. So I don't see the market maturing to a state of stagnation or saturation anytime soon, but it is a competitive space, no question. In the UK, it's a different kettle of fish. The buy now, pay later market in the UK is in its relative infancy. Yes, there are some big competitors over there, but Laybuy has demonstrated an ability in this market up against arguably the biggest, well, what is certainly now the biggest buy now, pay later company in the world, having been bought by Block. We've managed to hold our own here pretty well over the period of time that we've been up and running and available in New Zealand, and we're continuing to grow our presence in the UK as well. So competition, in my view, is good for everyone. It makes you better than yesterday, and that's a good place for anybody to be when you're trying to improve your business and grow your business.
Just on that UK market, would it be fair to say the UK is in buy now, pay later terms maybe 3 years behind ANZ, or are they even further back than that?
Good question. Look, the way I'll answer this is to provide you with some context to what we experienced. So my wife and I and our youngest son relocated up to London in August of 2018 to establish the business up there. And when we arrived in the UK, no one was doing what we were doing in the UK market. Klarna had a try now, pay later product, but they did not offer the buy now, pay later product they offer today. And once we started taking a couple of clients off them, they morphed quite quickly and started to offer their pay it in 3. We have benefited by both Klarna and ClearPay, Afterpay subsidiaries, marketing in the UK by raising the awareness of this product. I would say 3 years behind is probably a bit far. I would hesitate to say probably 2 years behind. would be my view, because the adoption is becoming very, very rapid now.
Okay. And then if we can just focus on the Australian market for a second, you're growing the number of brands and merchants that you're working with there who, maybe are exclusively Australian or have not come across as part of, an New Zealand expansion. And in that case, are you dislodging their current buy now, pay later provider, or are they seeing, Laybuy is a major player and I need to have them on board as one of a suite of buy now, pay later or payment options so that I'm, not losing those customers potentially?
Yeah, I think your second hypothesis is accurate. As a former retailer myself, I know that as a retailer, you offer customers the choice of how they want to pay, when they want to pay, and how much they want to pay. Otherwise, you lose to your competitor. And that's what retailers are doing, is offering Laybuy as an alternative to some of the other services they offer. The other product we have is that we are currency agnostic. So for retailers in Australia who ship into the UK, they don't need a UK website or a UK bank account. We will do all the FX for them. Therefore, we make our just circa 700,000 customers in the UK available to any retailer in Australia or New Zealand who ships up there. And that is a significant benefit for those retailers because it's a new customer base that they can offer their product to, and the customer can pay by Laybuy.
Okay, cool. And I just want to switch gears a bit to the new ad offering. Firstly, is that going to be across your kind of two main markets? And then maybe if we just drill down into how it will work, are you going to charge the merchants / brands to an advertising fee, or is it going to be more of a kind of a shared revenue / commission model? Just maybe give us a bit more details of the mechanics of how it's going to work.
Yeah, look, we're still working through the finer detail of that. What we are beta testing at the moment with some of our merchants is how best this works for them and us. But ultimately, it is an additional revenue stream for Laybuy. Regardless of how that revenue is generated, it will be a revenue stream for us.
Okay. And app exclusive, is that just a UK product, or is that a product that you've exported from ANZ into the UK market?
No, it's just a UK product at this point, and there is the opportunity for us to bring that down this part of the world as well. And again, that is part of our development roadmap.
Great. I'm just going to see if we got any questions currently. We don't. If we can look forward to the rest of 2022, if you go back to that strategy thing, I mean, is the key point, I guess, that the faster ramp up in the UK is really going to drive that top line, while at the same time keeping Australia and New Zealand ticking over?
Yeah, look, we're full throttle in every single market we operate. That's just the mindset we have as a business. But what we are very keen for investors to understand is that we are not schizophrenic. We are very focused on where we can grow our business most efficiently and where we get the biggest bang for buck out of that spend when we're looking to grow. So the UK is as I say, a relatively immature market in terms of buy now, pay later, that represents more opportunity and a better yield on dollars expended than some of our other markets. So it's just a matter of fishing where the fish are and taking advantage of a long runway that is still available to us in the UK.
Okay. Gary, we don't seem to have any further questions at this time. So I think we won't take up any more of your time, because I do know that our next presenter is patiently waiting for us. So thank you very much for coming back in and giving us an update on all things Laybuy, and we'll keep an eye out for the 4C that's going to come, I presume, somewhere around the end of April, and what else is going to come through over 2022.
Thank you, Mark. Thanks again for having me on. Really appreciate it. Bye for now.
Cheers. Thanks, Gary. And we are now going to move from Auckland to Singapore, because I know Mark Samlal joining us. I think this might be Mark's third time presenting here at Coffee Microcaps, going to give us an update on all things PayGroup. So Mark, if you want to just start sharing your screen, I'll let you know once it's coming through. Yep, I can see the cover slide now. Great shot of downtown Melbourne.
It is. Thank you very much for having me this morning, Mark. Right, do you have me there, Mark?
Yeah, I have you there. It looks like it's struggling to move to your next slide. Oh, there we go. Perfect.
Great, thank you very much. Well, good morning, everybody, and thank you very much for having me today on Coffee Microcaps. It's a pleasure to be back for the third time, and certainly our business from the last time we were here has moved along at a great pace, which is terrific. One of the ways that we measure our business, Mark, is obviously with compliant transactions, which create pays to be paid. And today, we're very proud to say that at the end of the last quarter, we're at just over 7.9 million payslip transactions on an annualized basis. And those payslip transactions create well over $10 billion in payslips payments to be made, whether they be payroll itself or the superannuation or the equivalent around the geographies that we serve, which has now increased to over 80 countries. Whilst we focus our selling efforts in Australia, Singapore, India, Hong Kong, where core companies to our solutions have their headquarters, we're today trusted by over 2,500 customers. And we've got a focus in certain market segments, and that is realistically around companies that are investing and growing within the Asia-Pac region. Why we operate is to provide local regulatory and compliance expertise throughout Asia-Pac on our customers' typically larger spend. And then what we have is a model that allows us to augment our organic sales organisation with partners in Europe and the US that ask us to assist their clients for our core geographies and our expertise areas. As we have over 7.9 million transactions on an annualized basis, what we are launching and have launched monetization, high margin activities within that base, and that's typically items such as cross-border movement of the payroll, part of the 10 billion that we create, as well as the superannuation requirements for those. In addition to that, we have the ability to offer a superannuation to our Australian clients and their employees, and I'll come to that later on the slide. But essentially providing one view of your workforce across many geographies that we can support you with. And we were very pleased at the end of Q3, noting that our financial year ends in March this year. We were very happy to reaffirm our guidance of at least 26 million statutory revenue and ARR guidance exit of the year of at least 37 million. So they're both affirmed. For the quarter that we've just closed, our new contracts that we signed in total contract value was 100% up on the Q3 in the previous period, and that was $5.6 million. And we've got a strong cash balance of 6.2 million as we enter into our last quarter of the year, which is traditionally our strongest from a revenue generation perspective, because many of our customers are Asian and have Asian employees, and we experience an extra pay cycle in Q4, so we get full payments in that period. Our monetization strategy, payments and superannuation, is up 181% on the previous reporting period, predominantly because we've been able to really inculcate that offering within our Australian client base. And it's scratching the surface, but we certainly are very excited about the superannuation offering, and certainly very excited about our customers choosing us and our partners to move their payroll monies around the world, with which we receive a service revenue for. And of course, the measure of our business, pay slips and transactions processed, that's up 46% as well. So really great traction from our organic sales organisation and our global partner program. So for those of you that are new to the story of PayGroup, we are a mission critical and compliance service provider and SaaS provider. We certainly have a unique and differentiated offering because the ability for our SaaS to be deployed in weeks and months, not months and years, is evident by the way that we can convert our contracts from cash to cash. And our services are there, so an organisation, should they not be wanting to use technology alone, have us to be able to provide those payroll services and or HR outsourcing services, very simple ones that are not strategic, and importantly, outsource the payments of the over $10 billion that we create in our technologies and our services to us. We're a customer-first organisation, so we're not going to discern with the organisation, prospect or customer whether they want SaaS from us or they want our SaaS and services. But we listen to the customer and we certainly execute on the best scenario for their business. We do have a diverse and growing client base. You'll see it shortly. It is enterprise. It is recognisable. And we are a very focused on profit. We have a profitable core business, and our focus as a management team and the board is certainly on improving our margins. Now, from a monetisation perspective, that's designed for enterprises. It's all about reducing their complexity to move their payroll and superannuation equivalent of funds and to employ their employee productivity, because we have the onboarding modules that allow organisations to onboard employees faster, smarter, easier onto our payroll SaaS or payroll services. And these days, obviously, as we talk about the great resignation often, we're seeing a great high level of employees leave one and join the other, and that's a perfect role for us. And from our clients' employees, the people that we pay, we've got products that we'll touch on later on that offer greater financial flexibility and opportunity. And that's ostensibly to be able to access their wage early. And this is our wages that they have already earned. Beg your pardon. So our technology and services are trusted by organisations such as you see on this page here. We are very focused on assuring ourselves that we provide solutions to the world's best companies. And they are sold typically to the global or the regional headquarters. And as one of our other shareholders has said on podcasts and presentations before, PayGroup takes a position of control at the HQ and then allows its abilities to cross-sell and upsell across more geographies or more solutions to be evident from that central point of control, being the regional or the global headquarters. And that's precisely what we do. So when we welcomed our first contract with Westpac, for example, it was for a very humble amount of employees in Singapore, but now Westpac are with us across a few different countries, across Asia Pacific, and as they've invested and grown, we've grown with them. And we see that same thematic happening with many of our clients. So how do we break up our business in terms of the core offerings that we provide? So we are a SaaS company, and we do provide services on that SaaS. We do use our proprietary software with all of our clients, and we do have payroll services. On the right-hand side, you'll see that as a tick, and the gross margins are split there for you as we present our businesses to our clients. Obviously, on the services side, we do have team members that are involved in providing that solution set to our customers on our SaaS. So the margin changes from a pure SaaS provider. Importantly, our customers sign with us for 3 years and have an automatic renewal. And in terms of our revenue splits, and obviously because services involve more solution sets, the revenue is higher for a services client than from a SaaS client, so the revenue splits is understandable. And from a transaction split, you can see that the high margin of SaaS has a greater amount of transactions. We're very focused in our business to assure that every revenue generating event is a pay slip and the opportunity to increase the share of wallet. So we enter with a position of control. We sell our solutions in payroll for SaaS or SaaS and services, and then we upsell into our other modules and to our other payments offering and our other superannuation offerings to our clients' employees via the onboarding process. So full service customer offering, as we've mentioned, we do have expert knowledge, and we do have a client relationship office that's focused on legislation and understanding the compliance in the areas that we work with. We now have expanded to 80 countries, so approximately 50% of the world's countries. But obviously, because we have a deep service solution in Asia with Indonesia, China, obviously India, we have the ability to serve the greatest part of the population of the globe. What's core to our business and why I started this business with 20 plus years of history is about rapid implementation. Our technology and our effort to implement solution sets is always focused on the ability to rapid implement, and also to ensure that we're getting a high quality, highly compliant OneView of your workforce within timeframes that the client's expecting. They don't drag on. We're very focused about that because that's the way that we measure the success of our client's engagement, is when the sales contract has turned into cash. So how have we grown? It's been terrific, the way that we've been approaching the market and strategic in the way that we've got a balance between our sales organisation and our global partners. But year on year, from a guidance perspective, there's 36% organic growth within our business, and we'll exit from an ARR perspective at least 37 million. So growth over a 3-year period has been 64% from the CAGR. And again, as a reminder, we're coming close to the end of our financial year, which is obviously the end of March this year. So our growth in FY22 has been solely driven by our organic capabilities. From a statutory revenue perspective, CAGR 71%, and obviously our exit rate of 26 million for statutory guidance for this year is very close to our proposed, our forecast ARR of at the end of last year, which was 27.2 million. Obviously, employment particularly in Australia, took quite a hit during the COVID period. So quite an unsettling period for employers and employees, obviously, namely the shutdowns. So there was a small amount of impact there, but we're seeing that going back to normal levels, definitely in the pay slips that we're processing. So we don't expect that phenomena to happen. So we're always, as a management group, very focused on our ARR guidance being as close to our statutory exit in the following year. That's how we measure ourselves as success. So we're trending positively with our focus, continued focus on margin. And the way that we're doing that obviously is increasing the share of wallet and services with our clients, whether they take on more countries, whether they take on more modules, whether they take on more services. DuPont in Singapore this week very pleasingly improved for one of their divisions the service level for another 200 employees. So we're constantly on that focus to be able to cross-sell and upsell into our client base. We are always rolling out increased automation activities for our services area, and that's very evidenced by the amount of transactions that we do in our services group growing per employee, and is a key measurement for us at management to make sure that those efficiencies are driven by increased automation. But what is a great driver is the increased deployment and the increased uptake for our enterprise clients around our monetization opportunities. And that is a significantly large addressable market internally, and has a very, very high gross margin revenue around our monetization and margin expansion efforts. So augmenting our organic sales team, which has grown over the years, obviously a part of our focus is to find outstanding people to help our outstanding client base provide these SaaS and services, is a terrific exercise that we embarked on approaching 4 years ago from our IPO of our Global Partner Program. So today our Global Partner Program, GPP, is delivering 31% of new sales. These partners are deeply integrated into our technology stack. It's not a handshake. They are contracted. We have distinct contract service levels. We have extremely detailed due diligence around the onboarding of a new partner in both ways. But importantly, our technology sets are integrated, so efficiency for our client base is most important here. We'll continue to expand. We're expecting to sign a significant new partner in the next few weeks, again, to add to this group. And it's typically these organisations don't have a presence in Asia Pacific. However, their employees, their clients do, and their employees need to be served. So very pleasingly, that partner program run by Foggo is delivering ahead of expectation. Low customer acquisition costs, clearly, and it's a high margin channel, and it certainly is complementing our direct sales activities, and we'll continue that focus. But again, deeply integrated from a technology perspective. So we're growing our enterprise client base, and that's evident. And our enterprise client base is absolutely growing their footprint. We're seeing our organisations in Australia who were typically landlocked during the last couple of years, now starting to expand and open up in new geographies, which helps us reduce their complexity, improve their own productivity. The introduction of the payments platform and HCM modules into our client base drives the share of wallet, and that's what we focus on. Taking a position of command at the regional head or global headquarters, offering our mission-critical focused payroll solutions, and then upselling as they grow or they can move out of their previous arrangements in new geographies, HCM modules, and then obviously asking the big question is to help them move their payments around the region, because it gives them a time advantage. Now, payslips are growing as well, clearly, and we are benefiting from the turnover in employment in Australia and other geographies, but it is higher in Australia, as we can see from other geographies. And as we obtain a payslip, each payslip certainly is a new revenue generation event for us. So we can attach an on-demand pay offering to that pay slip, and also we can offer the company the ability to move their payroll. Now, let's focus just on Australia for a moment, if we could. If an organisation has a PayGroup solution and we implement our SaaS, or we implement our SaaS and service, as an employee is newly onboarded into that organisation, they go through an onboarding process, obviously on our technology. And they join name, address, bank account details, all the normal things that you'd expect, tax file number. In that same workflow process, we've partnered with a Big Four bank, and that allows us the opportunity to then give that onboarding employee the opportunity to look at a superannuation fund or to look and choose. And both looking and choosing is an income stream for PayGroup. So whilst the Great Resignation and high employee turnover is a challenge for our customers and for us all generally, if an organisation typically had, 200 jobs, there could be 400 people flowing through those 200 jobs in any given period. So that volatility of employment is serving us well in that area. So the amplification of our superannuation offering and views on our platform is certainly the case, and job turnover globally, but particularly in Australia, absolutely goes to the thematic of why you should digitise all of your HR processes and have the most accurate compliant payroll systems certainly working for you, and services should you choose not to do it yourself. We're unlocking the value of our customer base. Our customer base is outstanding. You've seen the global brands, the recognisable entities. We certainly don't work in the mum and pop area of business. We are all about enterprise organisations. And importantly, we're seeing rapid growth around our monetisation as our technology for the monetisation offering is rolling out, and which we're investing in. And certainly the modules that we have, which allows organisations to do performance management onboarding. But paying our customers and to pay their staff, our customers paying us to pay their staff in different regions where they don't have a presence is very prevalent. The superannuation choice is certainly the one that's assisting in that rapid growth of ARR in monetisation, but cross-border payments is a larger portion of that. And accessing wages earned has been launched in India, has been launched in beta in Australia with one of our clients. It's not an advance. It is actually accessing the wages that you have already earned. It's a wellbeing tool, and it's promoted by our customers as a financial wellbeing tool within their HR policy. So there's definitely no debt leverage, and there's definitely no loans, predatory or otherwise, associated with that offering. It is a wellness solution, all to add to our clients assuring themselves that they're an employer of choice. So as we have a position of command within regional headquarters and certainly and global headquarters, we have got 27 modules within our solution set. We focus on payroll, we focus on payments, and we focus on one view of your workforce. After that, we then implement what organisations may like to take on secondly, and that's typically expense management, recruitment, learning and development modules and performance, those core ones that you see on the right of screen there. The recruitment module is clear why people need to digitise that process, both from the process of recruitment itself, as well as the onboarding with higher turnover these days. That's quite clear that we need to be able to offer that solution to organisations as simply and as targeted as possible. Our customers stay with us for a long time. Our average tenure today as an auditor is 9 years. And along with our 3-year contracts and automatic renewals, we've got customer retention sitting at 98%. Our customers spend more with us as they join. They spend more. We've seen Laser Clinics Australia now expand into different geographies around the world. We've seen Terminos out of Europe acquire 5 companies in Australia in the last few years. So that's certainly an example of where we are focused on helping our customers grow. We've recently won a great SaaS client for Hudson RPO throughout their organisations in Asia, and Weatherford, an oil and gas company listed in America, is expanding its operations throughout Asia. So they take on our solutions for more contracts. So out of our Q3 sales, 38% were upsells. And you can see the split between direct sales and our global partner program there. So 3-year contracts, 98% retention, automatic renewals, upsells, and further monetization of focus. There's continued investment in APACs, both from services and SaaS. And for those of you on the call that have an exposure to Japan, congratulations. We're seeing great investment into Japan over the last 6 months. It's been extraordinary. We'll focus on our enterprise monetization, increasing the adoption of our payment solutions, and obviously the addressable base is the over $10 billion that we create there, and the upselling of our HCM modules. And from payee monetization perspective, it's all about providing the solution sets to allowing our customers to be a employer of choice through the on-demand pay solution and others as we roll them out and integrate them via our marketplace to our SaaS and and service clients. We're governed by an outstanding board, industry experience and also capital markets experience. Very proud to be associated with our board, and we have an outstanding executive team at the C-suite guiding our product, guiding our client base, with deep expertise coming from some of the world's largest American organisations. Typically, we've got Chris Sharon, and also a very large compliment to Sachin, who's been driving the commercial aspect of PayGroup for over 8 years now, and the growth that we have and the recognition that we have in the industry, and certainly the client base is growing every day, hence the record sales that we've been experiencing quarter on quarter. I'll note some disclaimers as normal, and then I'll rest here today on our Contact Us page. Thank you, Mark.
Thanks, Mark. We have a couple of questions from the audience, so we'll get straight into them. You recently increased sales staff. How is your lead pipeline running into this calendar year? And are they fully occupied? Do you need to add even more staff to the business development team?
As a result of our global partner program and the soon to be announced new one, our sales funnel is absolutely has increased since the same period as last year. So we will always interview and understand who's available in the market. If they've got demonstrable skills and are talented and have the right culture set, we will add them. But do we need to? No, we don't. Our sales funnel is well in excess of 5x of this time last year, despite record sales, Mark.
Okay. You have done a few acquisitions over the years since you've been listed. Primarily, I think to kind of get you product offerings or stuff you can cross-sell into the base. Is there any other acquisitions you're looking at that either to get you into a specific market or to offer a neat little product that can be might be sold across the whole base rather than maybe the limited form that it's in now?
Mark, no, we have no further acquisitions to announce to the market, nor are we actively looking. We're excited, our clients are excited, hence the upsells and cross-sells that we're experiencing on our solution sets as it stands today. If there's something that makes complete sense to us to offer and we don't own it, then our marketplace will integrate it via our API structures into our current technology set and technology and service set. So we're very happy with where we sit today in the markets that we serve, hence the acquisitions. Our focus on Australian pay slips and Australian enterprises to allow us to further monetize via our superannuation offering and our on-demand pay. So we are happy today, and we will continue to receive interesting companies on a very high level. Maybe one every 2 weeks, somebody is seeking our views, but today we stand as we are and very proud of what we have.
And just on the the contracts that are announced and signed, I'm just curious, what is driving this big uptake in your product offering? Because I'm guessing a bit like accounting systems or other mission critical systems, people are not overly enamored with the idea of changing providers. So what's driving I guess this high level of sales that people are willing to switch from an incumbent payroll provider to the offering from PayGroup?
It shouldn't be a surprise, but it is a surprise that many organisations have got multiple providers within the region as they've grown themselves. So the exercise to look at who is a single vendor that I can trust, ASX listed, singly us, to be able to provide these solutions across the geographies that we do, whether they be a multi-site store, franchise retail, whether they be a contract organisation, Michael Page, Hudson RPO, whether they be Boston Consulting Group or DuPont or Appen. They are looking for digitisation, they are looking for better governance, and I don't have to say too much because most of us read the Financial Review to see how many payroll scandals there are out there as a result of poorly implemented technology or practices. So that's what drives it and the review of that. And we do know that particularly at the board level, payroll compliance and one view of your workforce has escalated in terms of focus and importance.
Another one from the audience. Do you see monetization revenue and payroll services revenue in general being the real growth engine for revenue accelerating going forward?
Our SaaS platform was landlocked to Australia, and we did acquire that one a couple of years ago. And for all obvious reasons, the last couple of years hasn't been the focal point around expansion, but we do see that as a global growth engine plugged into the balance of PayGroup's ability to serve across 80 countries. From a revenue perspective, the percentage of revenue to the group will always be SaaS and services and monetization because that requires our team members to execute on behalf of our clients, so therefore the revenue's higher. Margin perspective, we always looking to improve margin on both sides, but clearly a SaaS client has a higher margin than a SaaS and services one. So revenue, absolutely. Growth rate and pay slips, SaaS should always be contributing the higher.
Okay. Mark, we're just up on time now. We've ended nicely, exactly on time. Thank you very much for coming back in and giving us an update on all things PayGroup, and we'll keep an eye out for the Q4 numbers when they and the full year numbers when they come in April/May.
Thank you so much, Mark, and I appreciate being on this morning.
And I do know our next presenter is patiently waiting in the wings. So Mark, if you could stop sharing your screen, please. Thank you. And Daniel, if you want to start sharing yours, it's coming through now. Yeah, perfect.
Very good, Mark. Can you hear me?
I can hear you fine. Daniel, I'm just going to stop your video here just so we get a full clear view of the presentation. There we go. And ready to start whenever you are.
Okay, I'm ready. Fantastic.
Okay.
Thank you everyone for joining me this morning. I have a brief presentation here and then we'll do the usual opening to Q&A. My name is Daniel Foggo. I'm the founder and CEO of Plenti. Turning to the first page to provide you a little bit of context about our business. Plenti is a fintech lender, and I mean that in a true sense. In terms of the tech, I founded the business with two software engineers. So the technology side of our business is extremely important to us. We own our own proprietary technology platform, and that is a key point of difference in our markets. And then, you know, Fin, we also take very seriously. Maybe that's best represented by the fact that our head of credit was previously the head of credit at Amex in Australia, covering firstly consumer lending and then small business lending, you know, managing a $5 billion portfolio. So we think we truly bring together, you know, the key ingredients for a successful fintech business. To provide you some context, we've been in operation since 2014. We have built a loan book of over $1.1 billion. We have over 150 staff in Australia, and our run rate revenue in our December annualized was $97 million. So we're certainly starting to get to scale. I've mentioned the technology side of our business, and I'll flesh that out in a little bit more detail. But it is worth noting we have built our own technology from the ground up. When we established the business, we saw an opportunity to deliver better customer experiences. And we had a view that if we really focused on that customer experience, we could successfully take market share from large incumbents and build a business not only at scale or a business of scale, but also one that can operate more efficiently and therefore drive better economics. And so that is the journey that we have been on since we launched the business. We operate in 3 lending verticals, so automotive loans, renewable energy loans, so that is loans predominantly for solar panels and home batteries, and personal loans. We have, as I show in this deck, significant momentum in our business. We are gaining really significant scale, but actually the runway in front of us is still vast. We operate in extremely large markets, over $100 billion of consumer loans outstanding across the 3 verticals that we're in. So the opportunity for us is substantial in terms of runway. Our purpose as a business is really to help bring our customers' big ideas or dreams to life. So that's whether they're needing to buy a car to get to work, whether it's their desire to transition to an electric vehicle, whether it's their desire to save money on their power bills. We can help them do that through providing finance. I think the other thing to point out here is our mission. We're not shy in explaining our ambition is to be the best lender in each segment in which we operate. And that's really through bringing innovations to market, through raising the bar. And through our history as a lending business, I think we've done that very successfully, whether that's being the first to bring a fully digital personal loan experience to the market in Australia, whether it's bringing the most granular risk-adjusted pricing to our borrowers, whether it's opening up consumer credit to retail investors as we did when we launched the business back in 2014, or whether it's, when we introduced the ability for customers to get an indicative rate for a loan without actually hitting their credit score. We've continually sought to raise the bar and to deliver better experiences through the innovations we bring to market. And so that is all tied up in our mission to build Australia's best lender. Moving to the next slide, I'll keep this very brief, but we do take great pride in the technology that we have built and the technology capabilities that we have in-house. We have over 40 of our FTE in the business focused on product design and technology build. This means we are constantly innovating, constantly working on growth projects, and that is delivering results, as I'll show you on the coming pages. In particular, our own technology, our own platform has allowed us to be much more rapid or faster than a lot of our competitors. And that is increasingly important in Australian lending markets. For example, we work with a lot of broker partners, and the really important thing for them is, taking their client out of the market, if you like, providing them with approval for finance as quickly as possible, so that, for example, if they're buying a car, they don't then go into a dealership and the dealer provides finance. So that speed is increasingly important. It also allows us to build deeper integrations with our commercial partners, and we do work with commercial partners such as a large EV manufacturer. We've just signed up with AGL in Australia, with Energy Australia, and these large corporate partners are typically looking to work with us because we can build deeper, richer technology integrations with them, which means we can deliver a better experience to their clients or their customers. It means that we can make their business operations more efficient. So that is certainly key to our success. And the final thing that flows from that is we are constantly working on technology that improves our own efficiency. That is borne out in the financials you can see in our business. And if we break that down into individual areas such as underwriting, for example, the number of credit decisions an underwriter can make in our business is constantly improving, just by virtue of the increased automation that we can bring year on year. Moving to growth, the chart on the left here shows the originations we've made each quarter. Going back to the start of the last financial year, we have a March year end, and also the growth in our loan portfolio. You can see on the chart on the left that we are consistently growing quarter on quarter, and that the annual growth rate is very strong, over 100% in originations. So for the quarter ending 31 December 2021, our originations were up 135% year on year. Pleasingly also, if you look on the right, our loan portfolio, which is really what drives the revenue and economics of our business, has actually been growing on an exponential rate quarter on quarter over recent periods. And again, that has grown over 100% year on year. We reported our half-year results to investors in November last year, and in those results, we reported on some of the financial objectives that we had announced in May. The first of those was to reach $1 billion loan book by March 2022. Very pleasingly, we reached that somewhat ahead of schedule in November. We now, at 31 December, our loan book had reached $1.1 billion, and our stated target for the end of March this year is for it to be $1.25 billion. So we have stated an expectation that we can continue to grow that strongly. In terms of profitability, we stated an ambition to achieve a cash impact positive position on a monthly basis by June this year. Again, we were very pleased to report that we had achieved that in October. And then in our most recent quarterly, we confirmed that that has continued to grow on an upward trajectory. In terms of efficiency, we are a technology-led business. We're constantly driving efficiencies in everything we do. And so our cost to income ratio in the first half of this year was around 55%. Our medium-term target is 35%, and we're pleased to be driving forward strongly in that regard. And our target for the current half ending 31 March is for it to be below 50%. So certainly as we scale, we can see an ability to continue to drive really strong economics in our business. Our ambition is to build serious scale over the coming years, and that is most notably to build a loan book of over $5 billion, and to achieve that by calendar 2025. To give that some perspective, in the last quarter, we were funding over $100 million a month. If we just continued to fund over, or call it $100 million a month, clearly that's $1.2 billion of originations a year. That drives a loan book, if we were to do that on a steady state basis, of around $2.3 billion. And I think that puts into perspective our ambition in terms of growing to a $5 billion loan book. It actually requires us to grow originations more or less to about $250 million. And you can see the growth in our originations over recent periods put some perspective around that. Even at $5 billion, the market share we will have is actually sub 5% market share. So we certainly see that as an achievable ambition. How are we going to do that? That is really about deepening our presence in our existing lending verticals, namely auto, renewable energy, and personal loan markets. That is fundamentally through extending our technology leadership. It's through really doubling down on building brand and awareness around our business, through large commercial partnerships, as I've touched on, with our EV manufacturer, energy companies, and more to come. And we now have an ecosystem of around 600,000 customers, or people who have come to us for finance or to invest with us over time. So that is a lot of customer profiles. And so we're really investing on improving our capabilities around cross-selling to that customer base. Just to quickly touch on each of the verticals we're in. The fastest growing vertical that we're in, and the largest market that we operate in, is in automotive finance. The really exciting trend or structural change in the automotive market is we're seeing large incumbents exit the market. So Westpac sold its automotive loan book last year. That was over a $10 billion loan book. Macquarie has sold its dealer business. It's reducing its exposure to the broker channel. These are very favorable trends for other businesses to really build scale. We think we're exceptionally well placed in this regard, given the speed and the technology that we can deliver. Partners, be they brokers, be it going direct to consumers, or eventually potentially moving into the dealer finance market. To call out a few of the exciting growth opportunities in front of us, one is our position in the electric vehicle financing market. As I mentioned, we have a partnership with a large manufacturer where we are one of their key funders. We've also introduced a special EV loan product with features specific for EV cars. So that is, for example, an ability to top up a loan more easily if you want to purchase charging equipment, or software post the initial purchase of your loan, to be able to get cost-effective EV insurance and so on. So, and attached to that, we're also providing customers a 0.5% discounted loan rate. We're able to do that because actually the loss rates on EVs are lower, given the clients that they're tending to attract at the moment. But maybe more importantly, the fact that we've recently, or in December, we gained a EV-specific warehouse tranche with Westpac as our bank funder, and the Clean Energy Finance Corporation providing discounted mezzanine finance. So our overall funding cost out of that warehouse is actually over a % cheaper than the alternative. So that does allow us to help support the transition of Australians to EVs. We've also built our presence in the auto market through lending to consumers, so consumer automotive loans. half of the market in Australia is actually commercial customers, so small businesses, tradies and so on, purchasing vehicles. We've recently entered that market. We've only, over the last 6 weeks, rolled out to most of our broker partners. We see an opportunity to match our consumer originations of over $50 million a month to commercial customers over coming periods. So that's an exciting growth opportunity in front of us. We're also seeing some, the car purchasing habits change, reflecting what's happening in the US and UK and other markets, where it is becoming more common for consumers to purchase their vehicle online and have it delivered to them, rather than through traditional, processes through physical dealerships. Given we are a technology-led digital business, we are very well placed to integrate some of those businesses that are starting to build scale in Australia. And so we see that as boding very well for our growth aspirations over the medium term. You can see here that we've got a loan book of around $600 million in automotive finance at the end of December. Around a third of our originations are for new vehicles. Moving on to renewable energy finance, we believe that we're the largest funder of home batteries in Australia. That's partly through the fact that we run 2 very significant subsidy schemes in Australia. One where $100 million of subsidies is being provided to households in South Australia to support the installation of over 40,000 home batteries. And the second, a pilot we're running in New South Wales for the government for a scheme called the Home Battery Scheme. Empowering Home Scheme. Attached to that, we're a very significant financier in the solar markets. We have a loan book of about $130 million in this space, but we have great aspirations to expand quickly here. Our focus in that regard is partnering with the large energy retailers who are increasingly looking to provide their customers with bundled solutions, which includes batteries and solar panels and potentially also EVs over time. And when large expensive equipment is being purchased, there's an increasing need for finance to be attached to the customer offering. So hence our recent partnerships with AGL and Energy Australia. So we look forward to building our presence in this vertical over time. In terms of the personal loan market, I think the trends here are pretty well understood. It's a very fragmented market. We're seeing the market share of the big banks decline very significantly. We have got a very strong track record for growth in the space, and as a leading digital lender, our growth in the last 12 months, having just seen some industry data, I believe was the highest December and year on year of any consumer lender of scale in Australia. So we're doing exceptionally well. It's exceptionally well, particularly in the broker channel, where we work with over 10,000 broker partners. And we see exciting opportunities to continue our traction in this channel over coming months. I think a really important point to make here is that whilst achieving this strong growth, we've been able to do that while continuing to focus on very much the prime credit segments in Australia. You can see on the chart on the left here, the average credit score, Equifax credit score of our customers is very high at over 820, when if you look at the big four, their average personal loan customer, for example, would be well below 750 Equifax credit score. So we are targeting the most prime customers. And I think that's reflective by our credit performance. Very low annualized loss rates and very low arrears rates. You can see on the right chart there, our arrears rate at the end of December was at 20 basis points, which compares very favorably to other listed lenders. Now, that partly that is flattered by the fact that our loan book has grown very strongly, but it's also reflective of our prime lending in the auto space, where automotive loans tend to perform very well. If you look at Macquarie's book historically, the annual loss rates of consumer automotive loans are around the 60 to 70 basis points. And then in renewable energy, where loans act much like relatively small secured loans, who given they're made to homeowners. So we think we're in a very strong position from a credit standpoint. And we believe we've got very strong credit capabilities, be that the technology we've built to make credit decisions, and the technology we've built to price loans effectively through risk-adjusted pricing capabilities. And then finally, before we move into Q&A, I've mapped out some of our objectives over the coming half for our results to 31 March, and again, re-emphasised our ambition of reaching a $5 billion loan portfolio in 2025. We have great momentum in the business. We see really exciting opportunities in each of our verticals over the next 12 months, and we're excited about building or driving economics as we scale our business. In terms of some short-term catalysts or points of interest, I would note that we expect to complete over coming months, assuming debt capital markets remain stable, a second asset-backed securitization transaction. So we have around $300 million of personal and renewable energy loans where we're looking to turn them out from a warehouse into the debt capital markets. And through that, we're expecting to save over 100 basis points of funding costs. So that can have quite a material impact on our bottom line. On that, I would gladly pass it over to everyone for questions.
Thanks, Daniel. I might just kick it off if I may. Just when you're talking about warehousing and rates and stuff like that, can you give us a bit of an overview if we saw rates, from the Reserve Bank jump up, I don't know, let's say from where they are now by 2% over the next 24, 36 months, what that would mean for Plenti?
Sure. I think importantly, we hedge our loan book at the end of every month. So of our loans outstanding, we've sort of locked in the margin on those loans, if you like. So any change in the interest rate environment only impacts us on new originations. So therefore, the question really is, do borrower rates go up in tandem or in alignment with changes in funding costs? And I think certainly over recent years, as funding costs have gone down, that's obviously been passed on to consumers in broadly in lockstep. What we have started to see pleasingly as rates have started to go up, some of our sort of swap costs have started to increase, like most lenders, and we've started to see that come through in some of our lending verticals already, which is very pleasing. So in the automotive market and commercial automotive loans, we've seen Macquarie put up their rates by over 2%. We've seen other significant lenders like Pepper and Metro also put up their commercial automotive rates. And consumer automotive loans, we've certainly seen some players start to put up their rates. In the personal loan markets, we've seen lenders reintroduce fees and increase, some of them increase their sort of lowest rates for their super prime customers and so on. So we're seeing some pleasing trends there. But just like other businesses, funding costs are an input cost. So, obviously, it's important that we see borrower rates go up as funding costs go up, but the early signs are positive. I might also add there on the funding side of things, we have very diversified funding, which is a great advantage of our business. We have a marketplace lending platform where we've got over 10,000 retail investors. We've got another funding platform where banks and the government's CEFC has funded loans directly. And then we have two automotive warehouses, the second of which I mentioned we got in place with Westpac at the end of last year, where we're able to take out a lot of funding costs. And then we have a renewable energy and personal loan warehouse, and then we have the ABS we expect to implement over the coming months. So through our originations in our second automotive loan warehouse, where our cost of funds is somewhat lower, and through our second ABS transaction we expect to complete, we have an ability to continue to drive down funding costs across those receivables. So actually, for us, it's not all one-way traffic in terms of funding costs going up. We're also able to take some funding costs out on some originations, which is really pleasing.
If we just continue on originations, obviously they've been growing very strongly, and I dare say many X times system growth. I mean, who are you stealing, I guess, business or market share from? Is it, the Westpacs and the Macquarie's exiting and you're like kind of picking up some of that now that it's, getting redistributed within the market, and, brokers are kind of more inclined to look at you as opposed to having, a very solid relationship with Westpac?
That's entirely right. It's really about market share gains. We're not funding customers that weren't previously getting finance. We're funding customers that might have previously gone to Macquarie, for example. So it's really about building better customer experience, a better broker experience, delivering faster turnaround times, more consistent credit decisions, having really good sales teams, having really good digital end-to-end capabilities so that, customers stay with you through the funnel, if you like, and that is driving our growth. And so where are we taking that from? Yes, it's large incumbents in the automotive market, and then in the personal loan market. When we launched the business in 2014, banks had around 90% market share in Australia. That's reduced to, indicatively, in the 60s now. And so, we are one of the key businesses that are able to take up market share as we see some of those large incumbents lose share.
And then on the three verticals that you have, is there any plans as part of that move to the 5 billion to move into any other verticals? I know, as you said in your opening remarks, your head of credit also managed a large small business loan book when he was at Amex. Does that, is that a potential further vertical, or is it just concentrating on the three that you have and growing those?
When we talk of the $5 billion, that's very much focused on our existing loan verticals. So it's not an assumption around entering, the mortgage market or anything like that. It's about, just deepening our presence in existing verticals. We have a great technology platform that gives us an ability to introduce new products rapidly. It allows us to introduce, innovations where we enter new verticals. So this is not to say that we won't introduce new verticals over time. We have an ability to do that. We have a proven track record in doing that, from having first introduced personal loans and then extending into renewable energy loans and automotive loans. So never say never, but when you're growing at the rate that we are growing, it's really about just keeping your focus and your head down and just deepening your presence in current verticals.
And then if we look at the cost income ratio and the 5 billion, do they kind of arrive in tandem? In other words, when you get to 5 billion, such would be the scale that it kind of will naturally create a kind of a 35% cost income ratio, or, are they kind of to some extent moving independently of each other?
So we actually communicated to the market a medium-term cost-income ratio target of below 35% before we communicated the $5 billion loan book.
Okay.
And so the way I would, one should read that is that we do expect to reach that target sooner than the $5 billion loan target. So we announced that in May last year, and we talked about achieving that in the medium term. And look, I think the medium term for a fintech business is 2 or 3 years.
Okay, perfect. Daniel, that brings us pretty much up on time. Thanks for coming in and giving us an overview of Plenti. It was great to hear the story firsthand. And if anybody's got any further questions or wants to get on a distribution list for IR announcements, what would be the best one to use for that?
If they just drop an email to shareholder@plenti.com.au, we'll certainly add people to our list, and our ticker is PLT. Okay, perfect. And with that, we're bang on time. I will close this morning's event. Thank all our presenters and all our attendees, and wish everybody a good rest of their Thursday.